to 0.5%. Joining me now, John Lonski, Chief Economist at Moody's, and Jim Bianco of Bianco Research. Gentlemen, thank you both for joining me. John, let me begin with you. This is a market that took a bit of a breather, certainly in the last couple of days, but I get the sense it just wants to go higher. Would you agree?
Well, it wants to go higher as long as it believes interest rates are going to remain low and as long as it gets support from equity buybacks.
Jim, so it appears for now that the Fed remains on the sidelines and investors looking for yield. I would argue that the U.S. equity markets are the only place to find it. Dividend stocks must look very attractive.
Well, I don't know if they look attractive, but I'll agree that they're going to go higher. What it's turned out is Brexit was a big positive for the stock market. What it did was it put central banks in a near panic mode. They're talking about easing, no rate hikes here for a long time, and there's no change in the economy. So if you're just going to pump more sugar into the system, you're going to wind up with higher stock prices, and that's exactly what we have.
Jim, just to follow up, you know, there are those that argue this is an overheated market due for a pullback. Would you agree?
Yeah, by most of the valuations, you're at the second highest valuations recorded in the last 80 years. The only one that was higher was 2000. Most of the metrics that you would look at for valuation are now solidly higher than they were in 2007 when the market peaked. This is not a cheap market, full stop. It is, depending on how you want to measure it, overvalued or very overvalued. So you're buying into a fully valued market, and you're going to hope that central banks are going to continue to pump sugar and that the market's going to continue to go higher. And I think they will over at least the next few months.
And you know, John, what's interesting is all of this is happening against a backdrop where it feels like the world's on fire, but the markets have been unaffected. I mean, what would it take for these markets to be knocked down? Because it's been extremely resilient.
Well, I suppose we have to reach that point where a longer stay by subpar profitability, if not shrinking profits. Let's not forget, we're setting record highs with equities, even though profits are still sinking. If we reach that point where soft profitability prompts layoffs, that slows down consumer spending, the party is over for the equity market, and the economic recovery expires.
You know, that's a good point. What are the latest earnings telling us, Jim? What you know, to John's point, it's not exactly gangbusters, is it?
No, if you look at about a quarter of the S&P 500 companies have reported operating earnings, which is Wall Street's favorite metric, is going to be down 4.5% from a year ago levels, and this will be the 5th consecutive quarter of negative earnings growth. So we are in an earnings recession. And just to your previous question real quick, you know, with all of the news of today and the problems in the world, that feeds into the narrative that central banks are not going to be aggressive in hiking rates or stopping with stimulus. If anything, what's happening today in Germany is going to make them more stimulative. And that's why I think you get that perverse bad news is good news reaction out of markets. So actually it would be good news that might actually end this rally, and that means that central banks stop.
So, John, why are so many people still in cash? Are they missing out?
Well, I don't think so. You know, I think you have an overvalued market, as the other guest stated. It's a risky time to dive in at this point, and I think that's a good strategy because I believe that this economic recovery is running out of momentum. It seems as though auto sales are topping off. We got a nice monthly jump by home sales, but home sales growth has slowed significantly year over year. I wouldn't be surprised if we're looking at downward revisions of modest economic growth expectations for 2017.